Hello, welcome everyone. I am Joaquin Vespignani, Associate Professor of Economics at Tasmanian School of Business and Economics, University of Tasmania, and co-director of the COVID-19 and the Macroeconomic Research Program at CAMA with Professor René Frey-McGivens. We are very excited to have you with us and for this webinar by Giovanni Cacciano, on financial uncertainty and real activity, the good, the bad, and the ugly. This is a joint paper with Efren Castelnuovo from the University of Melbourne, Silvia Del Rio from Reserve Bank of Australia, and Richard Kima from Monash University. A little bit of the bio of Giovanni. Giovanni Cacciano is an associate professor in the Department of Economics at Monash University. Prior to joining Monash, he has worked at the University of Exeter, University of Glasgow, and University of Padua. His current research focuses on the macroeconomy effect of uncertainty shocks and on the stabilizing role of monetary and fiscal policy. We will hear from Giovanni for around 40 minutes or up to 40 minutes. And then we will open to the audience for discussion. If you would like to ask a question, please, we have 3 different ways to do it. Ask question by using the Q&A function. You can type your question into the Q&A box. You can also see questions from other participants. If there is a question that you like, you can click on the of liking or using the thumbs up symbol to upvote the question. I will post the most popular question to the panelists then. If you would like to ask questions via your microphone, please use the raise hand function on Zoom, and we'll allow you to turn on your microphone so that you can post the question directly to the panel. And finally, if you would like to ask your question on video, raise your hand, and also send me a private chat message to let you know that you would like to turn on your camera. Before beginning, I would like to let you know that this webinar will be recording the session. The session will be recording, and then we will be available in CAMA website after the event. And now I pass it to Giovanni for the presentation.
Thanks, Joaquin, and thanks also to René for the invitation. I hope the slides are set and you can see the slides. So as Joaquin said, this is a joint work with Efren, who is here, Richard Kima, who should be around in the audience somewhere, with a postdoc at Monash University, and Silvia Del Rio is at the Bank of Italy. And just as a slight correction to what Joaquin said, just for the sake of people coming from the Reserve Bank of Australia, Silvia is not one of your colleagues. She's working at the Bank of Italy. The paper is the idea behind the paper has been around for some time. At least between me and Efrem, it is in the line of our recent research on trying to understand under which conditions uncertainty shocks are particularly damaging for the economy. And then it has revamped and it has accelerated in recent months. So everything that you will see in this presentation is new. It is the first time that the paper, which is not written yet, is presented, except for an internal, for a short internal presentation. So any comments and suggestions, even after the seminar, would be very, very much appreciated, because we are the project is ongoing, basically. So to get an understanding of what is the question behind the paper, we can borrow a recent, a recent statement by Frank Partnoy, who is a professor of law at Berkeley and an expert of financial markets, who published an article in The Atlantic last week, saying that, well, imagine if, in addition to all the uncertainty surrounding the current pandemic, you woke up one morning to find that the financial sector had collapsed. Well, so the idea behind this paper is really to try to understand what happens or what is the effect of having high financial stress in the propagation of uncertainty shocks to the real activity. Now, the idea that uncertainty shocks and high financial stress might be a dangerous combination has been around for quite some time, at least after the Great Recession. Stock and Watson, in their famous paper about disentangling the channel, pointed out how the Great Recession was triggered by the joint action of financial disruptions and heightened uncertainty, and then a number of theoretical papers came out, or a few theoretical papers came out to provided an explanation of why uncertainty is particularly damaging when the level of financial stress is high. Among these contribution, there is one in particular by Alfaro Bloom and Lin, who coined the term finance uncertainty multiplier. What do they mean by finance uncertainty multiplier? Well, it's the idea that the presence of financial frictions amplify the contractionary impact of uncertainty shocks. So with and without financial frictions at work, uncertainty shocks might have a different impact on, a different contractionary impact on real activity. And the ratio, say, between the two responses can be defined as a multiplier. I mean, by how much financial frictions multiply or amplify the negative effects of uncertainty shocks. And they show in their paper, they have a micro-founded DSG model. What is the mechanism through which financial frictions amplify real activity? Now, when it comes to quantify this, or when it comes to quantify the impact of uncertainty shocks and by how much financial frictions might amplify the negative impact of uncertainty shocks, we face one clear one clear difficulty, and this is due to the fact that disentangling the two shocks is difficult, and it is difficult because proxies of uncertainty and financial stress are highly correlated. So this figure, the upper panel of this figure, plots one common proxy of financial uncertainty, the VXO, which is the implied volatility based on the S&P 100 stock market index, and one popular proxy for financial distress or credit market disruptions, which is the excess bond premium proposed by Gilchrist and Zach Reichek. Now, if we look at the proxy of financial uncertainty, the VXO, the blue line here, what we see is that, well, that there are three distinct peaks that the VXO has experienced since it is recorded, that is since 1986, and this corresponds to three easy to identify events. The first is the stock market crash in October 1987, the Black Monday. The second is the collapse of Lehman Brothers and the acceleration of the Great Recession of the global financial crisis in September 2008. And the third is the most recent jump in uncertainty in March this year due to the COVID-19 outbreak. Now, if we look at the excess bond premium measure, which is a measure of financial, or which can be considered a proxy of financial stress, since it is the portion of the corporate bond spread that is not explained by expected default of the firm, of the corporations that issue the bond, what we can see is that, well, eyeballing this graph tells you immediately that the two co-move, and indeed the correlation is quite high, is about 0.8 throughout the sample. But if we focus and if we look at the three events in which uncertainty has reached its highest level, well, the correlation between uncertainty and financial stress in these three events has been different. Look, if we look at this is what is reported in the bottom panel of this figure. If we look at Black Monday, in October in 1987, while financial uncertainty was going up, credit spread did not go up. Well, if anything, they went down. And for real activity, it was the outcome was good. So this is the good of our title. Uncertainty went up, financial stress didn't follow. No recession was triggered by the increase in uncertainty. Then if we focus on what has happened during the Great Recession, a different picture emerges. Uncertainty goes up and went up substantially, but also credit financial stress went up by a relatively similar magnitude. And we know that the outcome was bad. I mean, there was a deep recession followed. If we look at COVID-19 and what happened in March this year, something in between is happening. So there's been a big increase, a large increase in financial uncertainty of size that is comparable to what was observed in the Great Recession. While credit spreads, I mean, at least financial stress followed, at least from a qualitative viewpoint, what happened in the Great Recession, but then it didn't go up by much, possibly because of the quick and large liquidity injections of the Fed right after the COVID-19 outbreak. So this is the ugly outcome. We don't know exactly how ugly it will be, but we will try to say something during this, I mean, with our presentation. So the starting point is, okay, we observe a different correlation between financial stress and financial uncertainty in two specific events like the Black Monday and the Great Recession. Can we exploit this different correlation to disentangle first and second moment financial shocks? So this is the first question that we will try to address in this paper. Can we make use of these two events to disentangle first and second moment financial shocks? Then second, based on our identification approach, can we quantify this finance uncertainty multiplier? Or in other words, can we say by how much output will go down after an uncertainty shock if credit spreads or if financial stress does not react to an uncertainty shock? And then the third question is, based on what we have learned, looking at the different behavior in 1987 and in 2008, can we say something about the real effects of COVID-19, of the uncertainty shock induced by COVID-19 in presence of different degrees of financial frictions? So what we do in this paper to answer this question is we estimate a VAR where we model jointly proxies of financial uncertainty and financial frictions. Then we separately identify first and second moment financial shocks by proposing a novel mix of set identification restrictions. This will give us a set of identified models. We use this set of identified models to quantify the finance uncertainty multiplier by conducting counterfactual simulations in which we look at the different behavior, the different response of real activity to a given uncertainty shock with and without the response of financial stress. And then finally, we use the estimated VAR to simulate the real effects of COVID-19 induced uncertainty under different scenarios, and these different scenarios depend on different degrees of financial frictions. What do we find? A quick look at the results. Well, first, we confirm basically what is already known in the literature in terms of the qualitative response of real activity and financial stress to an uncertainty shock. Financial uncertainty is contractionary and triggers financial stress. Then the novel finding, the novel result of this project relates to the quantification of the finance uncertainty multiplier, and we find that financial frictions double the contractionary impact of uncertainty shock. So with and without a response of credit spreads to an uncertainty shock, we find that output would go down twice as much if credit spreads respond to an uncertainty shock. Finally, what we find is that if credit spreads are kept, when we look at COVID-19 induced uncertainty, what we find is that when if credit spreads are kept low, and in particular if credit spreads are kept at a pre-shock level, then the expected output loss induced by the uncertainty shock due to the COVID-19 outbreak can be reduced to up to 2/3. So the outline of the presentation is I will start by presenting the model, and in particular the identification approach that we use to identify first and second moment financial shocks. Then I will talk about the results, first in terms of impulse responses that we get, and then I'll show you how we compute and what we find in terms of the finance uncertainty multiplier. And then the final part of the presentation will be devoted to examine the economic costs of COVID-19 induced, the COVID-19 induced uncertainty shock. So the VAR. The VAR that we estimate is a standard linear VAR in which we model 4 variables, a measure of macro uncertainty, industrial production, which is our measure of real activity, a measure of financial uncertainty, and a measure of financial stress. The measure of macro and financial uncertainty are taken from Ludwigson, Ma, and Eng, so they are calculated as the common component of the volatility of the forecast errors of a large set of macro variables for the macro uncertainty index and financial variables for the financial uncertainty index. And our measure of financial stress is the excess bond premium, which I have shown you before in a graph, which has been proposed by Gilchrist and Zakrzajsek. We estimate the VAR using monthly data for the US, and the sample starts in 1973, which is when the excess bond premium becomes available, and ends in 2019. Now, to move from the reduced form residual to the structural shock, to the structural shocks, we proceed as follows. Now, assume that the system of contemporaneous relationships can be written as follows. Now, without any further restrictions, there is an infinite number of B matrices, the matrix of the contemporaneous relationships, that satisfies the covariance restrictions that come from the data. So what we do is we construct a set of a large number of these mathematically solutions that are consistent with the data by using the algorithm proposed by Rubio, Ramirez, Wagoner, and Za. So what we do is we start by initializing the B matrix using its lower Cholesky factor. And then we rotate this B matrix a large number of times by drawing an orthonormal, by drawing a large number of orthonormal matrices Q. This gives us a large set of models that are mathematically consistent with the data. Now, from an economic viewpoint, of course, not all solutions are interesting. So to get a constraint set of economically admissible solutions, we impose a number of restrictions on this set of B matrices. Now, what we do is we impose 4 different types of restrictions, which are restrictions that we impose directly on the shocks and restrictions that we impose on the impulse responses. Now, we follow Ludwigson, Ma, and Eng, and impose what we call event restrictions. That is, we require financial uncertainty shocks to be large enough, say to be large enough in October, in correspondence of the Black Monday in October 1987, and during the Great Recession in September 2008. Large enough means that they have to be larger, the realization must be larger than the 65th percentile of the empirical distribution of all possible, of all shocks. Then we impose the restriction on the first moment financial shock, the EBP shock, and we require that our EBP shock must be large enough in September 2008. And then to disentangle the shock, the first moment financial shock from the financial uncertainty shock, we require that the EBP shock must be small. It must be below the median in October 1987. We also impose event restrictions on the macro uncertainty shock, and we require that the macro uncertainty shock must be large enough in October 2008. And following Ludwigson, Ma and Eng, we identify output shocks by imposing that the sum of all output shocks realized during the Great Recession must be negative. Then again, following Ludwigson and co-authors, we impose correlation constraints on the financial uncertainty and EBP shocks by requiring that the financial uncertainty shock and the EBP shock must be negatively correlated with stock market returns. And we require that this correlation must be larger in absolute value than, it must be, say, lower than minus 0.1. Then we impose restrictions directly on, we impose restrictions on the impulse responses. We impose standard sign restrictions on financial uncertainty shocks, and we require that a financial uncertainty shock must be contractionary. So it must bring down industrial production, and it must trigger financial stress. So EBP must respond positively to an increase in financial uncertainty. And we do something similar for the first moment financial shock. We require that the first moment financial EBP shock must be contractionary and must trigger an increase in financial uncertainty. Then to sharpen the identification of first and second moment financial shocks, we follow what Furlanetto, Ravazzolo, and Sarferaz did and impose restrictions to the ratio of the response of EBP and financial uncertainty. So what we ask to our shocks is that, well, a financial uncertainty shock must push up both EBP and financial uncertainty, but financial uncertainty must go up by relatively more compared with EBP. And we do the same for the EBP shock. So on the entire, we start with an initial set of admissible solution equal to 5 million B matrices. And then we discard all the models that do not satisfy the entire set of restrictions that we are imposing. And so after imposing the set of restrictions that I've just discussed, what we end up with is we retain 56 models. That is, we discard more than 99% of all candidate shocks. Now, one thing that is interesting is to look at what what Primicheri called identification uncertainty. That is, look at what is the relative importance of the different restrictions that we are imposing in order to identify first and second moment financial shocks. So if we look simply at the event constraints that we have imposed on the Black Monday and on the Great Recession, what we see is that, well, the imposition of only this event constraints is quite powerful in discarding a large number of potential models. That is, if we impose both, we end up by retaining only 1.4% of all candidate models. If we impose only the Black Monday event restriction, we end up retaining about 13% of the models. If we impose the Great Recession restriction only, we end up retaining about 9.4% of the models. So this gives us an idea of how powerful these restrictions are in identifying and disentangling the first and second moment financial shocks. Then next, let's see what are the impulse response functions that we obtain from this set of 56 retained models. So this figure shows the set of impulse responses. Let me focus on the third and fourth row of this figure. The third row reports the response of the four variables in the VAR: macro uncertainty, industrial production, financial uncertainty, and EBP, to a one standard deviation uncertainty shock. What we observe is that, well, an increase, a financial uncertainty shock triggers macro uncertainty. It reduces industrial production, and the fall in industrial production as a peak in between minus 0.25% and minus 0.85%, and it pushes up the excess bond premium up to about 10 basis points. If you want to put this into the context of what happened during the Great Recession, the size of the shock during the Great Recession was about 5 standard deviation. This means that the increase in the EBP in financial stress caused by the uncertainty shock during the Great Recession, according to our model, could have been up to 50 basis points. The increase in the EBP itself during the Great Recession was about 150 basis points. So we could say that about 1/3 could have been induced by the financial uncertainty shock. The last row plots the impulse responses to a one standard deviation EBP shock. So we get, again, that EBP is contractionary, and it increases, at least in the short run, financial uncertainty. So wrapping up, that financial uncertainty shocks are contractionary and they push up financial stress. EBP shocks are contractionary and push up financial uncertainty. An interesting result that we get is that if we look at the effects of output shocks, we see that the effect is inconclusive on financial uncertainty, while typically a negative or a positive output shock brings down macro uncertainty. And this finding is in line with the contributions in the literature, for example, Ludvigson, Ma, and Eng, that show that while financial uncertainty is an exogenous driver of the business cycle, macro uncertainty is better characterized as an endogenous response to the business cycle. Then we come to the finance uncertainty multiplier. So what do we do to calculate the magnifying impact of financial frictions on output after an uncertainty shock? So what we do is, for each of the 56 retained models, we calculate the ratio, the finance uncertainty multiplier, as the ratio between the peak response of industrial production to an uncertainty, to a financial uncertainty shock. That is what we have just seen in the impulse responses before. And then we divide this by the peak response of industrial production to the financial uncertainty shock under the counterfactual scenario in which EBP, does not react to the financial uncertainty shock. So it is the ratio between, say, the factual impulse response that I've shown you before and the counterfactual response of industrial production that we would have observed in absence of a reaction of financial stress to an uncertainty shock. And what we get is the following results. Now, let me start with the figure in the left panel of this figure. So what we are plotting here is the impulse response, say the median impulse response of industrial production to a financial uncertainty shock, the blue line, in the model where EBP is free to react to an uncertainty shock. And then the counterfactual response, the dotted red line, which is the response of industrial production to a financial uncertainty shock under the counterfactual scenario in which EBP remains fixed to its pre-shock level. If we look at these two impulse responses, the corresponding finance uncertainty multiplier would be the ratio between the peak response that we get for the blue line divided by the peak response that we get for the red line here. It is important to notice that the horizon must not be the same. So the horizon at which the peak occurs must not be the same. And this is in line with the finding also by Alfaro, Bloom and Lean that say that the presence of financial frictions alters not only the magnitude of the response of output to an uncertainty shock, but also the persistence pattern of the response of output to a financial uncertainty shock. So this is simply the response, the factual and the counterfactual impulse responses that we get from one specific model that we retain. If we look at the entire distribution that we get from the 56 models that we retain, we get the figure on the right, so the histogram on the right, where we have that according to our identified models, the finance uncertainty multiplier ranges in between about 1.5 and 3.3 with a median value that is around 2. Now, these numbers are surprisingly and reassuringly in line with what Alfaro, Bloom and Lean obtained by using micro level data, firm level data. What Alfaro, Bloom and Lean showed was that on average, the finance uncertainty multiplier, I mean, basically they looked at the, to identify the finance uncertainty multiplier, they looked at the different response of financially constrained and financially unconstrained firms to an uncertainty shock. And they find that on average, the difference between the two, so the finance uncertainty multiplier is about 2, and it is around 3 during the Great Recession, so in an extreme event like the Great Recession. These numbers are in line with what we get, and these numbers are also confirmed by calculating, our numbers, by calculating the finance uncertainty multiplier by looking at the cumulative loss rather than the peak responses of industrial production. Now, what we do next is we turn to the analysis of the effects of the COVID-19 induced uncertainty shock. So we turn back to the initial question or initial scenario imagined by Partnoy. That is, well, what would have happened if on top of the uncertainty surrounding the pandemic, we would also have observed a very high level of financial stress. And to do that now, we have what we will do is we will use our estimated VAR to simulate the effect of an uncertainty shock of size comparable to what we have observed during the COVID-19 outbreak. Now, to do this, we have to move from the measure of financial uncertainty that we have used in the VAR, the Ludwigson, Ma, and Eng measure that is available only up to the end of 2019, and then we use the VXO as an alternative measure of financial uncertainty. Now, the two are highly correlated, and correlation is larger than 0.8. And the VXO shows that, I mean, that as a jump, as we have seen at the beginning of the presentation in March 2020 of this year, which is of comparable size of what we have observed in the Great Recession. So what we do is to calculate the response of industrial, or to simulate the response of industrial production to an uncertainty shock of size, of the same size of what we have observed during the COVID-19 outbreak, is we take our estimated VAR and then we calculate the output loss that we obtain with and without a finance uncertainty multiplier. To calibrate the size of the shock, what we do is we take the ratio of the VIX observed in mid-March 2020, and the level of the VIX observed exactly 1 month before. Okay? Well, this is due to the fact that we are using monthly data to estimate our model. This gives us a ratio of about 5.6. So the VIX went up in 1 month, or increased by a factor of more than 5. And then we attribute 90% of this increase to the COVID-19 outbreak. This 90%, this number, this 0.9, comes from a recent paper by Baker, Bloom, Davis, and 3 other co-authors that's looking at the behavior of economic policy uncertainty, and based on a search of newspapers, they found that 90% of the articles that were mentioning uncertainty and in March 2020, of the entire set of articles that were mentioning uncertainty, 90% also mentioned COVID-19 as the cause of that increase in uncertainty. And this gives us a shock of size about 5 standard deviations. So what we do is that we use this scaling factor to calculate the impulse response of industrial production to an uncertainty shock based on our estimated VAR. And what we do is we simulate 2 different scenarios. One is what we label an optimistic scenario. There is a jump in uncertainty in March 2020 of size given by what we have observed, and then nothing else happens. And then we simulate a pessimistic scenario, which is a scenario in which a second wave of COVID-19 hits in October this year. And following what has been mentioned in the medical literature, there are articles that tell us that the probability with which the second wave might happen is about 75%. We simulate the effects of another uncertainty shock related to the second wave, whose size is 75%. That observed in March 2020. And then we calculate for each of these 2 scenarios the counterfactual response of industrial production when the excess bond premium remains fixed at the pre-shock level. And what we obtain is, what we get is summarized in this figure. So the upper panel of the figure plots the cumulative output loss over a 1-year horizon induced by the March 2020 uncertainty shock. In the modeling, in the baseline model, say the model in which EBP is free to move, this is given by the histogram in red. And then we do the same by shutting down the response of the excess bond premium, and this gives us the histogram in green. Then we do the same for the pessimistic scenario, in which remember what we do is we hit the system with another uncertainty shock that happens in October 2020. Now, what we can see is that, well, if we compare the two scenarios, the size of the loss is not particularly different. The possible loss, output loss, according to each scenario is quite heterogeneous. We move from, if we look at the pessimistic scenario, from a minimum loss of about 10% to a maximum loss that is about 30%. And then what we get is that when we fix when we do not allow, or when we shut down the finance uncertainty multiplier by keeping the response of EBP fixed to the pre-shock level, what we observe is that, well, the loss reduction might be in a range in between 1/4 and 2/3. That is, the entire cumulative loss induced by the uncertainty shock during the COVID-19 outbreak can be reduced by up to 2/3 if financial stress is kept at bay. And this might be an indication that since we have seen that the excess bond premium has not gone up by much during the COVID-19 outbreak, possibly because of the massive liquidity injections by the Fed, this is an indication that this type of policy interventions can be quite effective in terms of saving output loss. So to conclude, I think I am in the 40 minutes time span that I've been given. What we do in this project, which is about to become a paper, we propose a new mix of set identification restrictions to disentangle first and second moment uncertainty shocks. We provide an estimate of the finance uncertainty multiplier that is approximately equal to 2 on average, with values that might range in between 1.5 and 3.3, which means that on average, financial frictions double the contractionary impact of financial uncertainty shocks. And then when we simulate the effects of the COVID-19 induced uncertainty shock, what we find is that if the finance uncertainty multiplier is not at work, that is under the counterfactual scenario in which the excess bond premium does not react to the uncertainty shock, the output loss can be reduced by up to 2/3. And this, we interpret this as evidence in support to the massive liquidity injections that have been done by the Fed right after the COVID-19 outbreak. And that ends my presentation.
Joachim, you're muted, I think.
Very sorry. Yes, now I am back on business. Thank you, Giovanni. Well, we have a couple of questions here. Let me invite someone here to ask some questions. But let me start with my question while I invite someone else. My question is, you know, what I see in your previous model is that you don't have COVID-19 infections there. And one of the question that I come up when I was doing another COVID-19 research is that, you know, there are like two different things that actually play into the uncertainty of COVID-19. One is the infection, the number of infection growing, and the other is the shutdowns. Because, you know, we know that in some countries the shutdowns were different to others, and given that your measure of output is industrial production, that may bring some questions about that. Well, do you have any answer to that?
Yeah, what I can tell you is that there is, I don't have the graph here, and my fault of not having the graph here, but there is an interesting graph that is being produced by researchers at the Bundesbank that shows how the VIX tracks incredibly well the increase in the number of infections that have been, I think it's the number of infections that have been recorded worldwide. So what I can certainly tell you is that there is a high correlation, high positive correlation between the number of infections and the VIX. In terms of, say, lockdown, timing of the lockdown and length of the lockdown and the VIX, I don't know whether or not you can find a similar correlation, but certainly there is a high correlation between the number of infections worldwide and the VIX.
Okay. Let me see if I have another question here, Paul. Let me see if I can read one of the questions here. I have here one. Okay, I have a question from Paul Kidney. Isn't the shutdown of financial uncertainty shocks due to not only to the quarantine of liquidity injection, but the change of policy to target corporate bonds by the Fed following the ACB and thus the EVP during the COVID-19 shocks?
Yes, that can certainly be the case. I mean, but I have to say that since we do not look explicitly at monetary policy interventions here, we are, say, speculating that the missing increase in the excess bond premium in March 2020 compared with what happened in the Great Recession is due to policy interventions by the Fed. So it can certainly be the case that targeting corporate bond spread or corporate bond yields is the policy intervention behind that, or is one of the policy interventions behind that missing increase. What we want to point out here is that by avoiding an increase in, or by keeping, say, the conditions on credit markets, or by keeping the availability of credit as at the same pre-shock level, is particularly important in terms of output loss.
Okay, now we have Loren Ferreira to ask another question. He's online, yes.
Hi, hello, can you hear me?
Yeah, a little, yeah.
Yeah, okay. Ciao, Giovanni. Good to see you.
Hi, Loren. How are you? Good to see you.
Yeah, I'm fine. I hope you too. Thank you for the paper. That's very, very interesting paper. Very smart paper. And I think that the question is extremely relevant now because it's very likely that in the upcoming months we are going to face a lot of company default in the US, and there is a huge risk of having a financial stress. Two questions. In fact, the first one, when you talk about disentangling the shocks of financial uncertainty, first and second moment, I mean, immediately I think about this paper by Caldara, Zakraszek, in Tal in the European Economic Review in 2016, I think, in which they do exactly the same by using a different approach. They use a penalty function. And maybe that could be good to compare a bit to this paper, because this is really a benchmark in this kind of literature, and to say how do you differentiate from this. And my second question was about in the VAR model that you use, what is the rationale of using the macro uncertainty into the model? I was not very clear about this, but otherwise, very, very good and very smart paper. Congrats.
No, thanks a lot, Laurent. These are two great questions because they help clarifying a couple of important things of the paper. Okay, we take a different approach from Caldara and co-authors, and I mean, we believe it is a more general approach to disentangling first and second moment shocks, because what they do is they use this penalty function approach, which is, I mean, it requires, say, that first moment shock must maximize the response of your proxy for first moment for financial stress over a given horizon, and uncertainty, second moment shocks, uncertainty shocks must maximize the impulse response of your uncertainty proxy over a given horizon. Now, here you still have an element of recursivity, because the ordering of the variables matters when you try to disentangle the two shocks by looking at the response, the impulse responses over a given horizon. And so in principle, but also practically when you go to the data, ordering your measure of financial uncertainty or your measure of financial stress first matters. Our way of approaching the problem doesn't have this limitation, and we believe this is an alternative way, which is a bit more general than what Caldara and co-authors did. But you're right in saying that this is theirs is a benchmark paper that looks exactly at the same problem in terms of disentangling first and second moment shocks. In terms of using macro uncertainty, we followed Ludwigson and co-authors, and so our VAR is LMN, so Ludwigson, Mayeneng, augmented with the excess bond premium. And the reason was that what they show is that the response of macro uncertainty to financial uncertainty shocks is important in transmitting the shock, in transmitting the financial uncertainty shock to real activity. So we stick to their baseline three-variate VAR. And on top of that, we added the excess bond premium with the aim of answering the question that we want to answer. But the way of answering your question is, there's that paper that we take as a benchmark, and the reason for keeping macro uncertainty, even if we are not interested in identifying macro uncertainty shocks, is that the response of macro uncertainty to financial uncertainty shocks is important in for quantifying the response of real activity to financial uncertainty shock. And this is their finding. Great. Thanks, Laurent. It was great to see you again.
Yeah.
Okay, I think that we have another question. Renee, you have a question?
Yeah, thank you, Giovanni. I just have to, just short questions, because my internet dropped out in a little bit of your main part of your results, so I'll have to watch the replay later. So are you concerned about the small number of models that satisfy the restrictions that you're imposing? Or do you see this as more of a feature because you are trying to identify something that doesn't happen very often?
Oh, that's a great question. I mean, yeah, we see it as we see it as an indication that the restrictions that we are imposing help us actually in identifying the shocks. There is a paper by Hulig in 2017 with a sort of decalogue, rules that you should follow when you do, or indications of when set identification works. And one of the points that Hulig makes is, well, you retain a few models, good, that's what. And we believe that the fact that imposing our restrictions reduces dramatically the number of models retained is a good indication that shocks are up to a point well identified. There is a counter argument to this, and this comes to a recent paper by Baumeister and Hamilton that tells you that, well, you know, if you retain few models, your findings might be due to, you know, not to economic relationships that you're identifying, but something like setting different seeds that can drive to different results. We have a check where we show that even if we retain, you know, a relatively small number of models, by setting different seeds, our findings on the size of the finance uncertainty multiplier are pretty much robust. So the answer to your question is, yeah, we see it as a good point, the fact that we retain a low number of models.
And so just one other quick comment. You were talking about the identification through the use of ratios.
Yeah.
I don't think you mentioned the Pearsman paper, identifying oil shocks. I think he was the first one to use ratios in identifying. He was trying to disentangle oil shocks and supply shocks, which has the same signs on the entire system of his variables. So he identified those by saying that the effect of an oil price shock would be bigger on oil than it would be on output if it was just a regular supply shock. So just something you might want to.
No, yeah, that's a great. Thanks for pointing this out. Yeah, we are referring to. Yeah, you're right. And I'll go back to that paper. We are referring to Furlanetto, Ravazzolo, and Sarfraz because they look at a similar problem as ours. I mean, they try to disentangle first and second moment financial shocks using ratio restrictions. But you're perfectly right. So I need to refresh my memory on the Pearsman paper. Yeah.
Yeah. Okay, I have the last question coming here from Emiliano Carlevaro. The question is, in the VAR, there is no role for monetary policy. Is this correct? If so, the counterfactual will be interpreted as the output loss by not enacting actions more aggressively related to what the Fed has done on average during previous uncertainty shocks rather than not doing anything.
Okay, I hope I understand the second part of the question. Yeah, I mean, we keep the VAR scale small on purpose. We have, we have done, I can't remember, we have done a check by augmenting the model with a measure of monetary policy stance. And to be honest, I mean, but to be honest, we didn't focus on monetary policy or, you know, the response on monetary policy per se. What we were really after was the disentangling the two shocks, keeping the size of the VAR relatively small. So again, it is a fair point, but we the interpretation of what we said at in the final part of our paper is more speculative. I mean, it's by saying that that there might be reason to believe that credit spreads did not go up in 2020 because the Fed reacted much more quickly and much more aggressively than before. But yeah, I mean, that's but we are not focusing. The answer is that no, we are not focusing on monetary policy.
Okay, we are finishing here then. Well, let me thank you for all your questions. We have come to the end of our session, and it was a pleasure to have Giovanni and co-author here. And next week, don't forget that we will have a very good presentation. The next event will be a webinar. It's here. Let me move the screen here. Is going to be on the global economic impact of COVID-19, and it's going to be Ian Kosef from World Bank and Warwick McKibben. And this is based on recently the World Bank has released a report on the economic impact of COVID-19 on the global economy, and Rosen Fernando and Warwick McKibben have updated their scenarios of the progression of the pandemic on economic outcomes. And that's why it's going to be a very good topic to listen next week. Okay, thank you very much to everyone, and see you next week.
Thank you. Thank you. very much for being here and attending to the presentation. And thanks again for the invitation.